Hey guys, Anthony here. Thank you for tuning in to another one of my videos. Today's video, we're going to discuss a more personal finance topic, and it involves investing. I'm going to, mix the two together. And we're going to talk about savings accounts. Should you use a savings account? Quickly to summarize, no, you really shouldn't. I'll elaborate more on that as the video progresses, but savings accounts suck. And you should know that. Many people often say, just put your money into a savings account. Save your money, save your money, save your money. That's bad advice. And I'm here to tell you that there are other things to do with your money out there. There are better ways to use your money than just letting it sit in a savings account. And in this video, I'm going to go over exactly why. Before we go any further, guys, like the video, especially like the content. Also, consider subscribing to the channel. It'll help me grow, reach new people, reach more people, and that would mean a lot to me because I want to make this channel as big as it possibly can. So if you don't mind doing that, I'd really appreciate it. Before we get into savings accounts, we need to preface this by talking about an ongoing phenomenon in the economic market, the economic climate that we're in, and that is inflation. So what is inflation? In simple terms, inflation is the rising of prices, or the rate at which prices for goods and services increases year over year. So currently, the inflation rate in the United States is forecasted to be 2% annually, meaning that prices for goods and services are expected to increase on a yearly basis at about 2%. So what exactly does this mean? It means that your dollar loses value year over year. If I have $1,000 stuffed under my mattress, in a year from now it is not worth $1,000 the same way as when I stuffed it under the mattress. Because prices rise year over year, that $1,000 can actually buy me less things than it was able to when I first made the $1,000. If prices increase 2% every year, essentially that $1,000 loses value at about 2% per year. Many people, when they say you need to make good investment decisions, they want you to beat inflation. They don't want your money to lose value. A poor investment decision, first of all, is to hold on to your money. Cash is not an investment. Cash is looking to make an investment later down the line, or if you're scared of making an investment. So holding on to cash is not a wise move, financially speaking. Holding on to cash will guarantee that you lose value over time. And you definitely don't want that. You want an approach that will guarantee that your hard-earned money will increase in value over time. And that can be achieved. However, not through a savings account. So I said inflation is roughly 2% annually, meaning to beat inflation, so in order for your money not to lose value on a yearly basis, you have to see a yearly return on investment greater than 2%. So if you were to get a 5% return on your money, your net return for the year would be 3%. So what is the average return on investment for a savings account? Well, it's definitely not 5%. It's definitely not 2%, it's not 1%, it's not 0.1%. The average return on a savings account, according to CNN.com, is 0.06%. Yes, 0.06%, not 6%, 0.06%. If you invested $10,000 into a savings account yielding 0.06%, at year end you would get $6. Yes, on an investment of $10,000, you would make $6 on a yearly basis. That's insane. That is absolute insanity. It's not even worth putting your money away because, one, $6 is nothing in the grand scheme of things, especially when you have that much money put away. And two, your money still loses value over time because 0.06% is significantly lower than 2%. You're losing money and you're not making a significant return anyway. So it's a lose-lose putting your money into a savings account. Am I completely against savings accounts? Yes and no, because savings accounts have their use. However, they should not be used as a vehicle to generate money. They should be used to preserve money, like an emergency fund, which I'll get to a little bit later in this video. Putting your money into a savings account and expecting some tremendous returns on investment is definitely a huge mistake many people make. With interest rates being at historic lows, for the unforeseeable future, returns on savings accounts are probably going to be 0.06% or lower going forward. Some banks have been offering high-yielding savings accounts. However, because of the nature of interest rates, at least in the United States, these rates have actually decreased year over year. So at one point, there were a number of banks offering interest rates above 2%, which would have beaten inflation by a pretty small margin, but it would have beaten it nevertheless. However, many have been forced to cut these returns simply due to the Fed and Jay Powell, Papa J, cutting interest rates even further. So many of these once high-yielding savings accounts with the yield of over 2% now pretty much across the board offer yields below 2%. So although it's much higher, significantly higher than that 0.06% figure, it still does not beat inflation. You are losing value of your money year over year, and that should not be. You should look to increase the value of your hard-earned money over a given period of time. You should look to generate wealth, and locking up your money into a savings account is not the way. Additionally, we should note that savings accounts have some restrictions in terms of withdrawals, so it also prohibits you from being flexible with your money. There are better options out there, and the best option, in my opinion, is to invest it in the stock market. According to Investopedia, the average return for the S&P 500, or just the stock market, is about 8%. That is 133 times greater than the average return for a savings account. If you had invested that same $10,000 into the S&P 500, after just 1 year, you would have experienced $800 in gains. In the stock market, there is really no ceiling at how high the returns can be. And that's a positive. You do not have to earn 8% annually. You can earn potentially more if you make some wise decisions. Savings accounts, on the other hand, are always at a fixed rate. They're always going to generate you that 0.06%. That can be seen as a positive because, you can lose money on the stock market. However, I think you need to have some risk. You need to risk it for the biscuit in this case. Yes, you can lose money on the stock market, but having a good chance of beating inflation year over year beats the safety that a savings account provides, because the return is just not there. If you were to invest your money into an index fund, which is probably the best and safest investment you can make, especially at a young age, on the stock market, you are almost guaranteed to have a good return on investment year over year. You're going to match market performance. Typically speaking, over the long term, the market is going to average an 8 to 10% return annually. That is significantly higher than a savings account and significantly higher than the inflation rate. So I think it's in your best interest to not use a savings account to generate wealth. You should not look to create money, to make money with a savings account. You should look to the stock market, look to index funds, look to secure investments on the stock market. I think that is the way to go, especially if you're young. You want to take on as much risk as possible, calculated risk, not just unnecessary risk. This is not Wall Street bets. Do not do options. You want to take on necessary risk at a young age because you can afford to make some losses here and there. Having your money in a savings account is pretty much the least risky investment you can make, and as a result, it has the lowest return on investment. I wouldn't recommend to anyone to try to make money in the savings account, not even people who are close to retirement. Bonds have better yields, have better return on investments than savings accounts do. So savings accounts really, in that regard, do not serve as a beneficial tool to create wealth. What they do is they serve as a great tool for an emergency fund. Anthony, what is an emergency fund? So, especially considering the time and the climate that we're in right now with the whole pandemic going on, an emergency fund is more applicable, more relevant than ever. An emergency fund is essentially money that you put aside in case of an emergency. Typically speaking, many people say you save 6 months worth of salary and expenses. Mark Cuban, billionaire, on Shark Tank, given how the pandemic really affected society, he recommends having a year's worth of expenses put away into an emergency fund. This fund is to make your life easier in case the worst case scenario were to actually happen. What if you did lose your job as a result of this pandemic and you had no money? You would be pretty out of luck. You might have to sell belongings. You might have to downsize. However, if you had an emergency fund that could last you 6 to 12 months, you could live comfortably while you look for that next job or while you try to land back on your feet. Further, what if you're strapped for cash month to month and then you have a huge accident and you have to pay out to get your car fixed. If you had to pay out of pocket for that, that could be a really big obstacle that you'd have to overcome, and you have to really maybe cut back on other things in your life as a result of the one accident. You're going to really suffer as a result of one mistake. If you had an emergency fund already saved, you wouldn't have to sacrifice anything. You can just dip into that emergency fund, make the necessary payment, and you can live life as normal. Dave Ramsey, financial guru, he recommends that people create an emergency fund before they even start investing. So what exactly should you do? It's up to you. I'm going to say again, I am not a financial expert. I'm not a financial professional, and this is not financial advice. This is just an opinion. These are all opinions that I have. I personally believe that try to create some kind of emergency fund as soon as possible. Possibly if you're younger and you can save away some money and you don't touch it, you don't invest it, you just let it sit there, I think that could be the way to go. And as you get higher paying jobs, maybe you look to increase that emergency fund to cover the new expenses that you may take on. Like Mark Cuban says, maybe 12 months of expenses saved up is the way to go. That may be difficult to do, but it may be very beneficial if this pandemic were to continue or something of this nature were to happen again. You may be lucky, very thankful and grateful that you planned the way you did. For an emergency fund, I would look for the highest yielding savings account out there. 0.06% is just ridiculously low, even if you do plan to save the money and use it as a rainy day fund. Why collect 0.06% on your money when you can collect somewhere around the 2% figure? That way, if it's around 2%, you're fighting off inflation to the best of your ability, so the money you save up isn't really losing value over time. Even if it does lose value, it does not lose as much value as money locked in a savings account at 0.06%. Chime, an online savings account, online bank, they offer a savings account that offers a yield of 1%. Citibank, they offer a savings account with a yield of 0.7%. These are some of the higher yielding savings accounts out there that are available to your disposal. Note they are significantly lower than that 2% figure I mentioned previously, but that is just the nature of how things are now with such low interest rates. But you should look for the highest yielding interest rates possible when it comes to a savings account, albeit make sure that they are safe banks. They're not shady, they're not scams. If they're FDIC insured, you should be safe. Do some research, do your due diligence, make sure that it is the proper investment to make. But yeah, for an emergency fund, save 6 to 12 months of expenses in a savings account with the highest yield possible, and do not touch that money unless an emergency happens. And emergency is not paying off your phone bill, it's not buying a new pair of shoes. An emergency is my family and I may go homeless if I cannot pay off my mortgage. I may go to bed freezing cold tonight because I cannot pay off my electricity bill. These are emergencies that qualify for you to dip into that emergency fund. Make sure it's an actual emergency. Doing this can allow you to be safe if some kind of disaster were to happen, financially speaking, and it'll allow you to focus on your investments without being worried of not having enough money in case that bad day were to come. You should also not touch this account to make investments. Do not do this. Stocks are volatile. You can lose money. Over the long term, you're not going to lose money. But what if you're down 1 year and that's the time when you need to withdraw money from your emergency fund? If you're down 10%, that's 10% that you cannot use for an emergency. Thank you guys for tuning into another video. Hopefully you guys understand the importance of not using a savings account to generate wealth. Guys, as always, if you want to watch more content similar to this, I post a couple times a week. Financial news, financial topics, dividend investing, retirement, personal finance, all that stuff. Subscribe if any of that content interests you. Also, if you have any feedback, comment down below. I like to see what you guys think about savings accounts. If you agree with me, if you disagree with me. I like to hear as many opinions as possible. Lastly, again, like the video if you enjoyed this video. Like, subscribe, comment, all that good stuff. If you do that, the channel will grow and I'll reach more people, and I would like that because I want people to see my content. You know how that works. But yeah, thank you for tuning into the video. It means the world to me. Check out the description below for all my social media accounts, my website, my blog, my podcast, all that good stuff. Check it out. A lot of content, a lot of good stuff. Similar stuff to this channel that I don't get to cover on the channel. But yeah, thank you. Until next time, I'm Anthony, and I'll see you later.